Yale's endowment has less than 10% of its portfolio in U.S. stocks, according to the most recent annual report. Family offices allocate 42% of their portfolio to alternative investments, with only 31% in public equities. That's according to Goldman Sachs' 2025 Family Office Survey. The most sophisticated investors on the planet, the people managing billions in endowment capital and generational family wealth, are not building portfolios the way your financial advisors were telling you to invest. Not even close. The question is, why most individual investors have never been offered the same approach. That's what we're getting into today. To understand why institutions invest the way they do, you need to understand one concept. It's called the illiquidity premium. David Swinson, who ran Yale's endowment for over 3 decades and built one of the best performing institutional investment records in history, built his entire framework around this principle. His argument was simple. Most investors are overly focused on public market stocks because public markets are convenient, not because they're the most optimal investment. If you have a long time horizon and don't need to liquidate capital tomorrow, you can earn a meaningful premium by investing in assets that aren't traded on public exchanges. Patient capital gets compensated for being patient. That's the foundation of what's become known as the Yale model, and institutions have been building on it for decades. Family offices put 21% of their money into private equity. They put 11% into private real estate and infrastructure, and 4% into private credit, according to Goldman Sachs' survey. That's over 40% in alternatives before you even count other things like hedge funds and other alternative strategies. The assets themselves aren't complicated. Private equity funds that buy and improve businesses, private credit funds that lend directly to companies at attractive rates, real estate syndications that own and operate properties, energy and other infrastructure investments that generate consistent cash flow. These are businesses and assets producing revenue. Institutions allocate to them because they provide diversification, income, and access to opportunities that simply don't exist in public markets. The opportunity has been there for decades. Most individual investors have just never been shown it. There are 3 reasons most individual investors have never seen any of this. The first is minimum investment sizes. Many institutional-grade private deals require minimums of $1 million, $3 million, sometimes $5 million or more per investment. If you're someone with, say, $3 million in total investable assets, putting all or most of it into a single deal isn't responsible, so you're just excluded from participating. The minimum is simply too high relative to your overall wealth to make it work. The second reason is access and relationships. Many of these deals aren't widely advertised. They come through networks of institutional capital allocators, family offices, and investment banks. Most financial advisors aren't plugged into those networks. Their world is mutual fund companies and ETF providers, and those relationships don't come with calls about private credit or pre-IPO rounds. The third reason is most frustrating because it's a structural problem with hiding in an industry that claims to work for you. Managing a passive portfolio of public securities is scalable. An advisor can service many clients with similar approaches. They collect their 1% AUM fee and they move on to finding the next client. Alternative investments require actual work per client, individual due diligence, suitability analysis, ongoing monitoring, educating clients on illiquidity. Here's the problem with AUM-based compensation. An advisor gets paid the same percentage of your assets whether they're doing simple or complex work. There's no financial upside for them to take on harder, more time-consuming mandates. The incentive built into their fee structure pulls them towards simplicity and away from the additional effort alternatives require. A flat fee changes that entirely. When you're paid the same, regardless of what you recommend, the only question is what's actually right for the client. That's the arrangement that removes the conflict. So let's talk about what the opportunity set actually looks like, because most people have never had this conversation with their advisor. Getting equity in high-growth private companies before they go public. Companies like SpaceX, Anthropic, OpenAI, Stripe, before they were household names. These carry meaningful risk. Many private companies fail, and I won't pretend otherwise. Worth understanding, too, is that accessing pre-IPO shares typically requires going through a secondary marketplace or a fund that has sourced those positions. And the legal and administrative complexity is real. But for companies that succeed, investors who got in early are buying at valuations before retail demand drives the price up. That structural advantage is significant. This is a niche that most people have never heard of, and it's worth understanding. In traditional private equity, capital is locked up for 7 to 10 years. But sometimes an investor who committed capital 5 years ago needs liquidity and wants out. They sell their stake on secondary market, often at a discount. Buyers of those positions are getting into established private equity funds at a discount with a shorter remaining hold period because they're coming in mid-cycle. You can see what's already in the portfolio before you commit, which removes a lot of the blind pool risk of a traditional fund commitment. It's a more transparent way to access private equity. Then there's lending directly to businesses that are too small or specialized for traditional bank loans. These funds may target returns of 10 to 15% or sometimes even higher. They're typically secured by company assets and senior in the capital structure, meaning they get paid back before equity holders in the downside scenario. In an environment where investment-grade bonds yield 4 to 5%, credit with strong collateral and senior position can be an attractive risk-adjusted opportunity. Many of these are floating rate structures, so if interest rates rise, the yield adjusts upwards. Higher yields do mean higher risk, and due diligence matters. But the risk profile of senior secured lending is meaningfully different from owning the underlying equity. The next segment is direct ownership in income-producing properties rather than just publicly traded REITs. Things like multifamily apartments, industrial warehouses, data centers. Investors receive distributions of rental income and participate in the appreciation of the properties at exit. The tax treatment of the direct real estate ownership, including depreciation and cost segregation, can also be a significant tailwind. The next one is direct stakes in assets generating consistent, predictable cash flow. Things like oil and gas production, renewable energy projects, pipelines, storage facilities. These tend to move independently of public equity markets, which is exactly the diversification benefit you're looking for. The common thread across all of these things is that they're businesses and assets producing cash flow. Institutions allocate to them because they work over a long time horizon. A few objections come up every time I have this conversation with people. The first is that this is only for ultra-wealthy people. Some deals are. There are opportunities with minimums that only institutions or ultra-high net worth investors can meet, and those aren't something we can provide access to. But many quality alternative investments have minimums of $100,000 or $500,000 per deal. For investors in the $2 to $10 million range, a thoughtfully constructed allocation to alternatives is entirely possible. The barrier has been access, not wealth. The second pushback I get is that alternatives are just too risky. Well, it depends entirely on the specific investment. Some alternative investments carry more risk than public equities. Some carry less. What matters is how they behave relative to the rest of your portfolio. Because they're not perfectly correlated with stocks and bonds, adding alternatives thoughtfully can actually reduce overall portfolio volatility rather than increase it. The third pushback that I get is that these deals are just too complicated. These deals require more due diligence than buying an index fund. That's true, but that's what an advisor should be doing. Evaluating the opportunity, understanding the risk, reviewing the terms, explaining it clearly. The question is whether your advisor is willing to do that work. The fourth pushback is that you have to pay outrageous fees to access alternative investments. This one is worth paying close attention to. Some advisors layer on their standard AUM fee and then charge a placement fee on top of that, sometimes up to 1 to 3% upfront. Then additional performance fees beyond what the fund itself already charges. By the time you add it up, the fee structure can make it genuinely difficult to come out ahead even if the underlying investment performs reasonably well. A flat fee structure eliminates that entirely. At Valorum, everything is included in our $15,000 annual fee. No placement fees, no performance fees, certainly no fee layering. We have no financial incentive to recommend one investment over another, which is the only arrangement where you can actually trust the recommendation. The point isn't that everyone needs alternatives. The point is that most investors have never been shown what's available and given a chance to decide for themselves. If you're curious what private investments might make sense for your situation, please book a call through the link in the description. We'll walk you through what we're currently evaluating and whether any of it fits your plan. I hope to speak with you soon.